Frequently asked questions. Tax code provisions for appreciated property. There are a number of tax code provisions available to taxpayers and business owners when they want to dispose of an appreciated property. And what I wanted to do in this brief segment is just review some of those tax code provisions. And let me begin with a caveat. There are many other provisions that deal with many other situations. So this is not meant to be an exhaustive or comprehensive review, but just to briefly discuss some of the tax code sections that taxpayers take advantage of in different situations. The first one is IRC Section 1031. This is a section dealing with tax deferral on the sale of a property used in a trade or business or held for investment when exchanged for other like-kind replacement property. So it might be referred to oftentimes as a 1031 exchange. IRC Section 1033, this is a provision in the code that deals with involuntary conversion. And there are a number of ways that this can happen. This can be an involuntary conversion when a municipality might want to take over a property for the common good, maybe expanding a highway or an interstate. There are other forms of involuntary conversion that might deal with things like storms or fires or things of those nature. So that's another tax code provision. IRC Section 121 is something that a lot of people are familiar with because it deals with a taxpayer's principal residence. And this provides tax exclusion on the sale of a principal residence when it's held by the taxpayer for 2 years out of a 5-year period. So many homeowners are familiar with this tax code provision. IRC Section 453. This deals with seller financing, or sometimes referred to as the installment sale rules. This is a situation where a taxpayer sells a property and they carry back a note. Essentially, they finance this for the purchaser. So over time, the buyer of the property makes payments on the note, and that might be a combination of interest and principal. Eventually, the note is paid off, and then that purchaser then owns the property at that point in time. So that's Section 453, and this is a popular tax code provision because it allows a taxpayer to split up their tax liability over a number of tax years. And then finally, IRC Section 721. This provides a taxpayer tax deferral when a real estate investment trust, which is referred to as a REIT, acquires a property that the REIT wants to purchase. And so the consideration for this, instead of the REIT purchasing the property with cash, the REIT provides that taxpayer what are called operating units, or referred to as an OP unit, in the REIT. So sometimes you'll hear this referred to as an UPREIT transaction because the taxpayer has a tax-deferred situation, and in exchange for transferring their property to a REIT, they receive these OP units, which essentially track with the overall portfolio of the REIT. So they go from having one asset or property, and now they have OP units that generally are associated with many, many properties, much more diversification. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.